Let's talk about money in Japan, because something interesting is happening right now today, on December 26, 2025. Tokyo, a city known for its vibrant energy and constant change, is experiencing a shift that's catching the attention of economists, business owners, and everyday people alike. The cost of living here is always a hot topic, but this winter, there's a new twist in the story. Imagine you're walking through Tokyo's busy streets. You notice prices, ramen, gadgets, have been rising. But this December the pace finally slowed. For months, people have felt the pinch as everything from groceries to electronics crept up in price. Now, for the first time in a while, shoppers are pausing, noticing that the increases aren't as sharp as before. It's a subtle change, but one that's being felt in wallets and conversations all over the city. Official numbers show prices in Tokyo rose by 2.3% compared to last year. That might sound small, but in economics every percentage point matters. Even a slight shift can impact how much families spend, how businesses plan, and how the government sets its policies. For a city as large and influential as Tokyo, these numbers are more than statistics. They're a signal of what's happening in daily life. This slowdown was unexpected, making everyone, from government officials to shoppers, wonder what's next. Tokyo's price trends often predict what will happen across Japan, so when inflation slows here, economists pay close attention. Businesses are rethinking their strategies, and families are cautiously optimistic, hoping this means their paychecks will stretch a bit further. The mood is a mix of relief and uncertainty. For years, Japan struggled with falling or flat prices. Now the challenge is the opposite, prices rising, sometimes too quickly. This shift is a big deal for a country that spent decades fighting deflation, where low prices once meant economic stagnation. Today, the conversation has flipped, and people are adjusting to a new reality where inflation is part of everyday life. This recent slowdown is a new twist. Is it a sign of stability returning, or just a pause before prices climb again? Experts are divided, and the uncertainty is making headlines. Some hope this signals a more balanced economy, while others worry it's just a temporary break before another surge. The answer will shape decisions for everyone, from the Bank of Japan to everyday families. As Tokyo sets the pace for the rest of the country, all eyes are on what happens next. The story of Tokyo's prices is just the beginning of Japan's economic balancing act, and the coming months will reveal whether this slowdown is a turning point or just another chapter in a much bigger story. You've heard of inflation, prices going up over time, but economists focus on core inflation. Core inflation strips out things with wild price swings, like fresh food and energy, to reveal the real trend. It's like checking your weight on a normal day, not after a holiday feast. This number is what central bankers watch most closely. In December, Tokyo's core inflation was 2.3%. That tells the Bank of Japan that price pressures are broad, not just a blip from expensive gas or lettuce. Core inflation guides big decisions, whether to cool the economy or let it run. It's the economic equivalent of checking your resting heart rate, not just after a sprint. The Bank of Japan's magic number for inflation is 2%. For years, hitting that target seemed impossible, prices barely budged. Now, for nearly 4 years, core inflation has been above 2%. That sounds like success, but it's more like a campfire turning into a bonfire. Inflation above target means rising living costs, especially if wages don't keep up. The BOJ is under pressure to act, even as inflation slows slightly. Think of the 2% target as a speed limit. Japan's economy was crawling. Now, it's speeding. Even with a slowdown, inflation is still above the limit. The BOJ must decide whether to tap the brakes or let things run a bit longer. That's why every small change in inflation is big news. Just when you grasp core inflation, there's core inflation. This strips out both fresh food and energy, giving an even clearer view of domestic price trends. Why? Because energy prices are set globally, not by Japan. In December, Tokyo's core inflation was 2.6%, still well above the BOJ's target. This shows that even without food and energy, prices are rising at home. It's a sign of strong domestic demand, not just import costs. The BOJ watches this number closely to judge if inflation is sticky. High core inflation means the economy might handle higher interest rates. It's a key signal that Japan's inflation is now homegrown and persistent. For decades, Japan had ultra-low or even negative interest rates to fight falling prices. But with inflation now above target, the Bank of Japan made a historic move, raising its main rate to 0.75%, the highest in 30 years. Raising rates makes borrowing more expensive, cooling spending and investment. This is the BOJ's way of tapping the brakes on inflation. Governor Kazuo Ueda has signaled more hikes could come if the economy and wages keep rising. The challenge: slow inflation without stalling growth. Move too fast and risk recession. Too slow and inflation sticks. This rate hike marks a new era for Japan's economy. The world is watching to see what the BOJ does next. With a major rate hike now behind us, everyone's asking the same question: what's next for the Bank of Japan? After years of ultra-loose monetary policy, the central bank has finally shifted gears, and the world is watching closely to see what their next move will be. The BOJ expects core inflation to dip below 2% soon, as the effects of previous cost increases gradually fade from the data. This means that, for a short while, prices might not rise as quickly as they have in recent months, offering some relief to consumers and businesses alike. But the bank predicts this slowdown will be temporary. As the economy continues to recover and strengthen, they believe prices are likely to start rising again, especially if demand picks up and companies feel confident enough to pass on higher costs. Wage growth is the key factor here. If workers start earning more, they'll have extra money to spend, which can boost demand and fuel healthy, sustainable inflation. The BOJ is hoping for a virtuous cycle where higher wages lead to more spending and stronger economic growth. The BOJ faces a tricky balancing act: raise rates too soon, and they risk stalling the fragile recovery, but wait too long, and inflation could surge out of control. It's a delicate situation, and every move is being scrutinized by markets and policymakers around the world. That's why they'll be watching the data closely. Jobs, wages, consumer spending, and business investment will all be under the microscope before the BOJ makes another big decision. They want to be sure the recovery is real and lasting. Most likely the bank will pause and observe for now, taking time to assess how the economy responds to the recent changes. Patience and caution are the watchwords as they navigate this new phase. Governor Ueda has made it clear he wants to see real, lasting wage growth and solid evidence of a self-sustaining recovery before acting again. He's determined not to move too quickly or too slowly. The ultimate goal is to guide the Japanese economy to a soft landing, avoiding both a sudden crash and runaway inflation. It's about steering carefully through uncertain waters. Every decision now is about balance and timing, finding just the right moment to act, so Japan's recovery can continue without new shocks or setbacks. While the central bank manages rates, the government faces its own challenge: a record 122.3 trillion yen budget for 2026. That's about $783 billion, covering everything from social security to defense. But much of this money comes from borrowing, not just taxes. Japan's public debt is among the world's largest, raising concerns for financial markets. To reassure investors, the government aims to limit new borrowing below 30 trillion yen for the second year in a row. The debt dependence ratio, how much of the budget relies on new debt, will fall to its lowest since 1998. It's a small but important step toward financial stability. like paying more bills with your salary instead of credit, it's progress. But the road is long. Japan's budget choices now will shape its economic future. Japan's economy faces more headwinds. Factory output fell 2.6% in November, worse than expected. Key industries like autos and batteries cut production, signaling weaker demand at home and abroad. This slowdown threatens jobs and growth, complicating the BOJ's rate decisions. Meanwhile, the Dendem, the Ider, Imalban, Iwalbijainen, Hanbeinaven remains weak. That once helped exports, but now it's a problem. A weak yen makes imports, oil, food, more expensive, fueling inflation. This cost-led inflation isn't matched by higher wages, making people poorer. The government is so worried, the finance minister has threatened to intervene in currency markets. Japan's recovery is still fragile, with tough choices ahead. Why should you care about Tokyo's prices or the Bank of Japan's moves? It might seem distant, but the decisions made in Tokyo's financial heart can have a direct impact on your daily life, no matter where you live. Japan is the world's fourth largest economy. What happens here ripples globally. Tokyo is a powerhouse, influencing everything from international investments to the cost of goods on store shelves. For years, Japanese investors sent trillions abroad, fueling growth in markets from New York to London. Their money has helped stabilize economies and support businesses worldwide. Now, with the possibility of higher interest rates in Japan, that money could start flowing back home. This shift could shake global markets, causing volatility and uncertainty for investors everywhere. Less demand for U.S. bonds, for example, could push up American interest rates. That means higher borrowing costs for businesses and consumers, potentially slowing economic growth in the U.S. and beyond. Japan is also a key player in global supply chains. Factory slowdowns here affect companies worldwide. From cars to electronics, disruptions in Japan can lead to shortages and price hikes everywhere. The yen's value impacts global trade, making Japanese goods cheaper or more expensive overnight. A sudden shift in currency can reshape the competitive landscape for businesses across continents. Japan's Economic Balancing Act is a test case for other developed nations. Its strategies for managing growth, innovation, and demographic challenges are closely watched by policymakers worldwide. How it manages inflation, debt, and policy shifts will offer lessons for the world. The choices made in Tokyo could influence how other countries respond to their own economic challenges. The changes in Tokyo signal a new era for global finance. As Japan adapts, the world will be watching and reacting. Even from afar, Japan's story could shape your world tomorrow. Whether you're an investor, a consumer, or simply curious, Tokyo's economy is more connected to your life than you might think.